In the wake of ongoing market turbulence and concerns about the stability of regional banks, the practice of short selling is facing heightened scrutiny. Short sellers who profit by borrowing shares they believe will decline in value have come under fire for exacerbating market volatility. As a result, calls for stronger regulatory control over short selling are growing louder. Recent data from Ordex revealed that short sellers made approximately $1.2 billion in profits during the first 2 days of May alone, primarily from the banking sector. Watchell, Lipton, Rosen & Cox, a prominent legal firm known for its defense of major businesses in high-stakes mergers and hedge fund battles, has joined the chorus of voices advocating for stricter oversight. In a letter addressed to its clients, Watchell proposed that the U.S. Securities and Exchange Commission implement a 15-trading-day ban on short sales of financial institutions. This temporary prohibition would serve as a preventative measure against what the firm refers to as coordinated short attacks, by providing authorities with the necessary time to act and investors with a chance to process information. Watchell believes such a ban would mitigate risks to the U.S. economy. Watchell's recommendation reflects a similar move made during the 2008 financial crisis when short selling was temporarily banned in the United States. However, subsequent analysis by the New York Federal Reserve revealed that the ban had little impact on market stability. Despite this, Watchell argues that reintroducing a short selling prohibition is warranted in light of the current market conditions. The SEC, on the other hand, indicated that it is not currently considering a short selling ban. While concerns over bank solvency continue to weigh on stock prices, the SEC declined to comment on the possibility of implementing such a restriction. However, according to an unnamed source familiar with the situation, federal and state regulators in the U.S. are actively investigating potential market manipulation behind recent significant movements in banking stock prices. SEC Chair Gary Gensler has affirmed the Commission's commitment to detecting and pursuing any form of misconduct that may pose a threat to investors, capital markets, or overall market integrity. Some hedge funds have profited greatly from the failures of banks like First Republic, Silicon Valley Bank, and Signature Bank. While critics of short selling argue that the practice exacerbates market volatility, organizations like the nonprofit Better Markets contend that responsible short sellers play a vital role in alerting markets to the challenges faced by smaller banks. Sam Adrangi, the founder of hedge fund Carisdale Capital, defended short sellers, highlighting their role in curbing stock promotions and holding management teams accountable. Adrangi emphasized the value they bring to financial markets, stating, "It is a very worthy service we provide to keep financial markets running efficiently." Amidst these discussions, the KBW Regional Banking Index continues to experience significant declines, down 30.4% year-to-date and 11.3% month-to-date. The market remains uncertain about the future of regional banks, fueling the debate on the impact of short selling and the need for regulatory measures to address market volatility. As stakeholders continue to weigh the pros and cons of short selling, the financial industry eagerly awaits further developments in the regulatory landscape. The proposal to restrict short positions in the United States has sparked a lively debate among market participants and regulatory authorities. While some argue that such restrictions are necessary to curb market manipulation and protect the economy, others express concerns about the potential unintended consequences of limiting short selling. Proponents of stricter regulations contend that coordinated short attacks pose a significant risk to financial institutions and the overall stability of the economy. They argue that by imposing a temporary ban on short sales of financial institutions, regulators would have a window of opportunity to intervene and prevent potential market abuses. This viewpoint finds support among those who believe that short sellers exacerbate market downturns and can drive stock prices lower than their fundamental values, potentially causing financial distress for targeted companies. However, critics of short selling restrictions argue that such measures could have unintended negative consequences. They argue that short sellers play an essential role in uncovering overvalued stocks, exposing fraud, and maintaining market efficiency. Restricting their ability to take short positions could hinder market transparency and inhibit the flow of information that benefits investors. Moreover, some skeptics point to the 2008 ban on short selling, which had limited impact on market stability, according to subsequent analysis by the New York Federal Reserve. Meanwhile, industry experts and organizations are expressing a range of perspectives on short selling. Some investors believe that short sellers act as a necessary check on market excesses, exposing weaknesses in companies and promoting healthier market dynamics. Others argue that short sellers can take advantage of market vulnerabilities and manipulate prices for their own gains. Amidst the ongoing discussions, the KBW Regional Banking Index's continued decline underscores the challenges faced by regional banks. This significant year-to-date and month-to-date decreases in the index reflect market uncertainty and raise questions about the future prospects of these institutions. Stakeholders are closely monitoring developments in the regulatory landscape to assess the potential impact on market dynamics and investor confidence. As the debate on short selling restrictions intensifies, regulatory authorities are likely to face increasing pressure to strike a balance between curbing market manipulation and ensuring market efficiency. The outcome of these deliberations will shape the regulatory framework and investor sentiment regarding short selling practices in the United States. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.